Minutes from the latest Fed meeting signaling that policymakers are on track to raise rates in July. Here with more on what this means for the market for investors, we want to bring in Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Brian, it's good to see you again. So when you take into account what we're learning here from these minutes, what traders are pricing in terms of the odds of another rate hike at the next meeting in July, what do you think this means for equities?
I think that it means that the Fed, they really don't know what the data will be, so they don't know what they're going to do. Central banking is really a game of credibility. They're very concerned about inflation expectations and making sure that those stay anchored. And so they really want to strike this note of being very vigilant about inflation, saying that, hey, we are willing to hike more. Here at Annex, on our investment committee, we're not sure that they have a lot more hikes in front of them. And that just is simply because the data is showing that the broader economy is slowing and inflation is very gradually rolling over. It's doing it at a very glacial pace, but it should be good enough where maybe at best they need to hike one more time, and then they can just kind of call it quits for the balance of this year.
And Brian, we know the Fed likes to say often it's not just about one data set, but we do have a big one coming up later this week with the jobs numbers coming out. To what extent is that likely to affect the Fed's decision? And what do you think that number needs to be in order to at least get officials a little more comfortable with the fact that things are, in fact, pulling down on a consistent basis?
Yeah, and that's just it, on a consistent basis, right? They want to make it very clear that they are data dependent, but that doesn't mean data point dependent. It is really about the broader picture, the whole mosaic of data that they're looking at. And so it's really about getting 3 months in a row of seeing slowing down of the labor market, making sure that wages aren't growing too rapidly. And then next week with the inflation numbers to see whether or not we are on that trajectory towards eventually getting to 2%. So when it comes to this Friday's number, I think it's really about those wage numbers. It's not necessarily the headline number about how many payrolls expanded. It's not even necessarily the unemployment rate. It's just about, is that wage number year on year, month on month at a rate that is consistent with 2% inflation. So anything lower than 3.5% as far as year on year wage gains, I think the Federal Reserve will think that they still are on that path towards their ultimate goal of 2% inflation.
Brian, given the fact that inflation has been so sticky, it's still way too hot for what the Fed would like to see with their 2% inflation target. There has been more and more talk over the last several months that maybe that 2% target should be revised. Maybe it should be more like 3% at this point. Is that something that you think maybe should be on the table or something that the Fed could potentially consider at some point?
That's a good question. And it really, that 2% number, it really was pulled out of thin air in a way. Really, New Zealand back in the 1990s is the one who kind of set 2% as being that type of inflation target that most developed market central banks have adopted. And there's really no good reason for it. You look at historically, the average is closer to 3%, but they've sort of painted themselves into a corner here. They set 2%. It's an arbitrary number. But if they were to try to move that or modify that now, it would be a very negative signal to the rest of the market as to their ability to actually get to any sort of target. They really shouldn't think about modifying the target until probably at least, say, 5 years down the road when they have gotten to 2%. We think they'll probably get to 2% over the course of the next 2 years, but they should first prove that they can hit that goal before they contemplate whether or not they should modify the goal.
Yeah, and it's sort of along the lines of what we heard from the heads of the major central banks last week when that discussion came up in Portugal. We've got two key pieces of data that was out Monday show that the U.S. manufacturing sector is in a slump. Demand remains weak. Production is slowing due to lack of work. How long do you expect this trend to last? And is this a sign of what we're likely to see past the summer?
Yeah, unfortunately, manufacturing is stuck in the mud. And really, we're going to be getting the ISM services number tomorrow. We have to see whether or not the service sector strength continues. But we're not expecting that manufacturing is going to stage any sort of rally between now and the rest of the summer. It might be an early 2024 story as far as the manufacturing recovery. Now, markets are forward-looking, and so they're going to try to anticipate when the activity is going to improve. Unfortunately, it does does look like the market is expecting that this is perhaps the end of the earnings recession. Earnings for the S&P 500 peaked back at the end of 2022, and on a quarterly basis, quarter on quarter, they've been declining. Analysts seem to be expecting one more quarter of a decline and then the beginning of a rebound. That might be a little premature here, which is one of the reasons why we're very focused on trying to participate in the markets, but having the emphasis more on quality equities as opposed to just going sort of with the go-go growth story.
Well, Brian, I guess what do you think is the more realistic time frame then of that, just in terms of when we will see some improvement on earnings?
Yeah, we're expecting that we're going to see the improvement on earnings mainly towards the end of 2023 here, perhaps early 2024. According to the FOMC minutes that were released, the staff economists are expecting that we're going to see a recession, 2 negative GDP growth rates in the fourth quarter and then the first quarter of 2024. Earnings oftentimes will bottom during those recessions. And so if the market moves about 6 months ahead of that, we could be positioning ourselves for a decent, sustainable recovery for the markets, maybe more towards the fall period, let's say around October or November. But of course, it all depends on how the data rolls in, right? If the Fed is right with the projection of a recession in the fourth quarter, we think that's a pretty reasonable estimate that right now there's a few more rain clouds that are beginning to form over the markets.
So what are some of the investing themes you're sticking to in the face of some of those clouds forming?
Yeah, so we want to participate because there is some decent value, especially outside of the biggest tech names that are out there that have been driving the market higher year to date so far. We do like some of the smaller cap names, some of the international names as well in the equity markets, but it's really more about this theme of focusing on quality. And for us, quality is kind of in the eye of the beholder. To us, it's really defined based upon whether or not they're able to have resilient margins relative to their peers. So it doesn't really matter which sector they're in. Is it a company that actually is able to ride through what could be a challenging environment by maintaining their margins? Have they already done the cost cutting necessary in order to ride through any type of perhaps mild recession that we might encounter? And a lot of those names are more in the smaller cap, the mid cap names, and then also outside of the United States.
Brian, what about fixed income, the bond market? Where are you seeing the most opportunity there as investors are trying to balance or add some sort of balance to their portfolios?
Yeah, but here at Annex, when we're looking at it as far as the fixed income profile, it is somewhat of a barbell approach. If you think about the cash that you can hold, getting a decent amount, but eventually cash rates will begin to fall once it gets to the point where the Federal Reserve is going to start cutting. That might not be until the end of 2023, maybe early 2024. So you can kind of ride in cash. You can make hay while the sun is shining there. But then as far as to get a little bit more income, we like the higher quality, high yield names, not necessarily scraping the bottom of the barrel when it comes to credit quality. It's more the creme de la junk. So the things that are the higher quality where it has a short duration, low likelihood of default. And that's how we're trying to sort of balance the safety when it comes to cash, but a little bit more income when it comes to getting that high yield exposure.
All right, Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Thanks so much for your time.
Thank you.